Working Wall Street taught me that in a very mightily way. And I love watching someone reach their goals. So that's like really what gets me going is like, okay, like what are your goals? Let's figure it out. And then finding ways to help them do it. So that is my passion. And so anyway, with that being said, I'm going to start talking about taxes. So a lot of people, we have a lot of real estate in our office. I don't know if it's because I'm from Chapin and I know a lot of people in Chapin. I been in Chapin since 1983. So I was a young buck, young girl, whatever. Whenever we moved here, my parents are from Newberry and Spartanburg, so I have a lot of family in the area. And so when I started my business, I was actually told by another person in this town who said, there's no way CPA firm will ever survive in Chapin. And I was like, well, we're gonna find out. Here we go. And I have been very blessed. So with that being said, a large portion of my business is real estate, and I have a ton of real estate agents and a ton of real estate investors, and we work with a lot of variety of stuff. So with that being said, I'm going to talk to you first about depreciation. So who knows anything about depreciation? Okay, all right, and everyone, you love depreciation when you are owning the business. And unless you have actually depreciated a property and then sold it, you do not know that you hate depreciation when you sell the property or the business, right? So when you talk about depreciation, if you're gonna buy and hold, right, you're gonna do that, and if it's a residential rental, it's 27.5 years. If it's a commercial, it's 39 years. There's this thing called a cost segmentation analysis. I'm sure some of you have heard of that. I don't know if you have or haven't. But if you're going to own a commercial property, I would highly recommend doing a cost segmentation analysis. There are definitely pros and cons to that. But depreciation is non-cash, so it feels really, really nice. In the when you're doing your tax return, you're like, oh, look at that. I'm getting this big deduction, and it feels so good. And you do that for, I don't know, let's say you buy and hold for, I'm using you as an example because you were talking about buy and hold. So I do it for 10 years. I've depreciated this property, and then I think a lot of our clients, when they first sell their first property, they think they still have a basis of $300,000, which is what they bought it for. However, when you depreciate a property over 27.5 years, that is not the case. So instead of it being, and I don't have a calculator with me, but let's spitball it. Instead of having a $300,000 basis, I have more like, I don't know, 220. Yeah, I was gonna say like I'll use 70,000. That's the number I was gonna use. So yeah, 220. So I'm selling for 220. So when my basis is 220, and then I go sell, and I'm selling for 350, I've got a lot larger gain than I think I have. Okay, so that's really, really critical for those of you who are gonna hold for any period of time, because depreciation rate capture is a bitch. Okay, and everybody who has experienced it will absolutely shake their head on that. So we have a lot of clients who buy and hold, and now we have employed the 1031 exchange over and over and over again for those people. And I actually have a client right now who has a basis based on all the 1031s we've done, deferred gains. The basis is so small. It's like the next time they sell, there's nothing left. So they're gonna have to recognize a pretty big gain here pretty soon. So with that being said, depreciation is beautiful and nice. Cost segmentation analysis, does anybody know what a cost segmentation analysis is? Has anybody ever done one? No, has anybody ever heard of it other than that? Okay, you've heard of it, okay. So cost segmentation analysis basically takes the property and it splits it up into depreciable assets that are not just the building. So I'm gonna use a commercial building because that's a little bit easier. So I'm gonna buy this building, and it's a commercial building, it's $500,000, and then they're going to break that building up into audiovisual, plumbing, electrical, sidewalks, and whatever. And I'm going to depreciate all of those on an expedited schedule. So 7 years, 15 years, that type of thing, instead of 39 years, right? So you can see if I'm looking for deductions, I'm definitely wanting to do that, right? Especially if I think I'm going to make good money on it. So what happens though is that when you do that cost segmentation analysis and you have all this personal property, audiovisual, plumbing, electrical, that we are arguing is personal property, goes on a business personal property tax return. How many of you have filed those before? Business personal property tax returns are also bitches. It's my least favorite tax that South Carolina charges. And if you have a vacation rental, by the way, all of you have vacation rentals, you are supposed to be filing one of those for like Cindy County or whatever county you're in. Most people don't do that, but if you get caught, it's not a happy day. So It's very ugly. Horry County is the best county that I know of. They do an outstanding job. They know when there's a rental, and they are all over it. Lexington County, not so much, because we don't have a hospitality tax in Lexington County, but that's one of the reasons Horry County is so good. But anyway, those assets and the cost segmentation analysis become personal property, so they do go on personal property tax return, so that's a negative, but still, you can still expedite that depreciation instead of 39 years. So just something to think about, cost segmentation if you're going to be doing apartments, if you're going to be doing vacation rentals, if you're going to be doing commercial properties. I don't necessarily have many guys who do, or girls or guys who do it on residential rentals. So that's the cost segmentation.
I have a quick question about that. Does it have to be done the first year that you own it?
It has to be done by the time that you file the tax return for the first year that you own it.
Okay.
So for example, if I buy the house and it's not in service, like I'm renovating it, I don't have to make that decision. But the day I place it in service and I file the tax return for that year, so let's say I place it in service on January 1st of 2024 and I file my tax return in April of 2025, I have to make that decision by April of 2025.
Okay.
Or if I extend October of 2025.
Okay.
But great question. So, okay, so depreciation is beautiful, and then it's not. And then cost segmentation analysis is beautiful, and it can hurt, depending on your personal property tax situation. A lot of you kept saying that you were doing this. I think some of you said it full-time, some of you said you did it part-time. So passive activity losses, how many people have ever heard of those? Yeah, so passive activity losses is one thing that gets a lot of people and they don't understand them. So I'm gonna kind of go over it. By the way, I'm hitting all these topics, and if you want me to dig into any one of them like a little deeper, I just need you to say, hey, can you dig into that? Because I don't want to bore you either. Passive activity losses basically says that I am not materially participating, this is not my main business, and by default, real estate is passive, okay? Like in the Internal Revenue Code, passive activity, real estate's included in that, okay? So if I make more than, if I'm married, who's here is not married? How about that? Not married, okay. So I will say a few things about not married then. Okay, so if I'm not married, my threshold starts at $75,000. If I'm married, it starts at $125,000. But if I have passive activity losses, and I have a W-2 job, and then I have a rental property, which again, by default is a passive activity, then, and I'm gonna use my number for the married. So at $125,000, I start phasing out being able to deduct that passive activity loss, okay? And at $150,000, I don't get any deduction for that year, all right? So when people walk into my office, which we have a lot of people who walk in and they make $300,000, $400,000 on W-2, and then they have a couple of rental properties, and they say, oh, I had a huge loss on my rental property this year, and I'm gonna get to take it. And then I say, oh, are you materially participating in your rental property? And they're like, I don't know what that means. And then I ask a few more questions, and it turns out that this is not a material participation. They don't even spend 250 hours a year, much less 750 hours a year, and they don't spend more than 50% of their time doing this business, okay? So all that means that they're passive. So, and then I'm like, oh, guess what? You don't get any of it. And that is like painful, right? It's for a lot of people, they want that loss. So it depends on your income, but if you're 150 or above. So then those passive activity losses, they get suspended, okay? So you don't get to use them, but they roll forward with you. Yes?
But if you're like us two, and your main job is property management,
Yep.
and do you then get to take that big loss?
It depends.
On your personal rentals?
It depends.
You're getting there, aren't you?
I'm gonna get there.
You do it.
Yeah, I'm going. I'm going to the real estate. I'm going to the real estate professional thing. We're gonna hit that. Okay, so what happens is it gets suspended. You don't get the loss. We had a guy who is a real estate professional who did not get to take his losses. In 2023, he sold the house and he has suspended losses. About $13,000 a year was his average suspended loss, and he had it suspended for like 10 years. So he was calling me saying, I'm gonna get killed. I'm gonna get killed, because he understands depreciation. I'm gonna get killed. And I said, I don't think you're gonna get killed. And he was like, okay, I love you. I'm like, no. I mean, love me, okay, great, but no. You have suspended losses of like $130,000. He was like, oh my gosh, I did not even realize that. And so we had talked about it, but he didn't understand what it meant. So when he sold that property, all those suspended losses become an ordinary loss in the year of disposition, okay? So when people say, oh, I hate passive activity losses, it's kind of like the opposite of depreciation. I hate passive activity losses in the year that I have the losses and I can't take it. But in the year I sell, I'm like, oh, I love those.
Thank you.
Right? Does that make sense?
Yes.
You can't take them until you sell the house?
You can't take them until you sell the property. Passive activity losses are suspended per activity until you sell that property. Or unless you have other passive income in that same definition, not dividends and interest, but like other passive activity income. So if you have royalty income, or if you have an investment in a partnership that's passive, then you can take that loss against that. So
that's above the threshold. The loss is above the threshold of 100.
Yeah, if your loss is above the threshold of 150, if your income's above 150 without the loss, okay, without the loss, then you have your loss is suspended. But then if you have a passive activity that's income and you're still above the 150, and I'm going to use a partnership as an example because there's lots of people invest in partnerships and they have passive income, then you do get to take that passive loss in that same year. But I'm going to get to you in a minute because y'all do it full time. So I'm going to get to y'all. Okay, so that gets suspended, right? But again, when I sell it, I'm like, yes, this is really beautiful. I'm kind of happy now because now I don't spend all my money on my taxes when I sell my property, right? Because I still have depreciation that I have to recapture again, of course, okay? So now let's say that I'm not a W-2 person and I do spend more than 50% of my time doing real estate and I am a licensed broker or I am a licensed real estate agent or some other way that I can say that I am a real estate professional, okay? And there's lots of definitions that qualify as a real estate professional. And again, more than 50% of my time I spend in real estate. That is very critical for where I'm going. So if you have a job and it's a W-2 job and you work that 2,080 hours a year, the IRS does not believe you if you then go say you're a real estate professional on what I'm about to talk about, okay? And there are so many court cases. Every year, there's about 3 court cases that support my position. So when I say that, I'm not saying this like, oh, willy-nilly, like, oh. So with that being said, I have more than 50% of my time, and I materially participate in this activity, which means no one spends more than 100. I spend at least 100 hours, and no one spends more time than me. Okay, that's like there's 7 different tests of material participation, and that's the easiest one to meet. Okay. So I spend 100 hours at least on this activity, and no one else does more than me. Okay?
In your business.
Yes.
Yeah. Okay. Yeah, in my business, right?
Like, what about the guy that lays on the floor?
Yeah, in my business.
Yeah.
Right. In my business. Not including your contractor.
Okay, thank you.
Okay. Then what happens is, and I'm going to talk about your one Airbnb. Okay, you have one Airbnb rental. Okay. And then if I want to get more than active, I'm active participation at that point, right? But there's this law that they passed a while back called the Real Estate Professional Designation. Have you ever heard of that? No. It's okay, most people haven't. So the Real Estate Professional Designation basically says, and the IRS's position is, you spend more than 50% of your time and you materially participate, and if you want to take it, which means you don't have any passive activity loss limitations, you get to take all the losses in the year that you have the losses, okay? But the test is 750 hours per activity documented. 750 hours. How many hours do you have in a year? So if you work 40 hours a week, that's 2,080 hours, right? So when you ask, can I take my losses, right? I'm a real estate professional. Can I take these losses? Well, if you spend 750 hours per property, then sure. Per property. If they're not in an entity, the entity holds them, like a partnership or an S corporation holds them.
If they're not in an entity.
If you hold them individually on your Schedule E.
Oh yeah, no, why would you do that?
A lot of people do, so I'm trying to cover it all.
And as a professional?
So if you have each property on your Schedule E, and there's separate properties, then it's 750 per property. If you make an election and you say, hey, I'm going to group these together and I'm going to treat them all as one property, then you can do 750 for the group. But that also has pros and cons to it. And that gets really technical, so I'm not going to go into it. But just know that opportunity is out there if you make that election, but make sure you understand that election when you make it. And that, again, gets super technical.
When you say group them together like a holding company?
No, you're going to be on your Schedule E. like you have them on your schedule, right? Like here's A, B, C, D, right? I've got my, 501 Sumter, 301 Ott, 506, whatever, right? I've got my 4 different rental properties. Well, I can say that as a group, I spend 700, I'm more than 50%, right? No one spends more time than me. And altogether, I spend at least 750 hours. So then I'm a real estate professional. Check the box, real estate. I'm not active, I'm real estate professional, right? There's 4 boxes to check. The last one's real estate professional. Real estate professional, and I am going to be taking this losses this year. So I can elect to group them for my 750 hours on that Schedule E, okay? So, but again, that has pros and cons, just like cost segmentation, okay? Just like depreciation.
Is
just
that like
tax
buying
activities.
several properties under one LLC?
Okay, I'm gonna get to that in a minute.
Okay, so
I'm going there. I'm going.
I think right now you're basically just talking about like if you're as an individual.
Yeah, I'm doing individual
Yeah,
investors
but
right
it's
now.
just like
If you own your
people,
properties
not a
as an
company.
individual. Yeah,
If you have it under your personal name.
right. Yeah, and there's a lot of people who do that. So
Yeah.
I'm not sure if anybody of you do, and I'm not saying you do or don't, but a lot of people do. So, all right, now, let's sit. Yep.
Just one last thing.
Uh-huh.
When you said put them in a group, you weren't talking about putting them in an LLC?
I'm
What
saying-
did you mean?
I'm saying I make an election on my personal tax return. I make an election to group them as one kind of property. I'm saying that they're all a group, and I treat them more like a business. So I can do
Does it have to
700.
ownership of your
No,
style or
it doesn't.
whatever? That's
You
all.
can do it as an individual.
Yeah.
I own them as Erin Long Bergeson, and I own 7 different properties, and altogether I spend 750 hours on those 7 properties. So now I can take those losses. Okay? Yeah. Okay, now we're going to talk about entities.
There we go.
All right.
You're in the right room.
There we go. All right, now,
I'm like, huh?
a lot of people, so we're going to talk about entities. So a lot of people think, oh, I got an LLC, and I'm this, and I'm that, and you say, okay, so who's your partner? Oh, no, I just own it. Well, guess what? For the IRS, that means you don't have anything. If you're an LLC owner, and you're a single member LLC owner, unless you make an S election, or unless you make a C Corp election, you are nothing to the IRS, okay? It's called a disregarded entity. If you're a single member LLC without an election, you are a disregarded entity, which means the IRS says, I don't know who you are. I don't care who you are. And that means that if you have a small business, you're going to file on the Schedule C on your individual income tax return. And if you are a rental, it's a Schedule E, okay? So it's very important that you understand that when you get an LLC, having an LLC doesn't mean anything to the IRS unless you have more than one partner or unless you make an election, okay? So, yep.
Could that partner be your wife or no?
Yes.
Okay.
Yes, you can do that.
More than one.
More than one wife?
You said more than one.
More than one owner.
You said more than one partner.
You have to have more than one owner.
Okay.
So
You said
two
more than one
partner.
partner.
You have to have a partner.
I was like, wait, I thought a partnership worked, and she said more than one partner. That's a 3.
No, like more than one owner is what I meant. Yeah. So more than one owner. So you have to have 2. And by default, LLC, IRS says LLCs again are disregarded. But if I'm a multi-member LLC, more than one, I am now a partnership by default. Okay? These are I'm going to call these basic, but I will tell you that they're misunderstood by like 90% of the population. Okay? So this is super basic, but also totally not understood. So now I have a partnership with my wife. Okay? I have an LLC, multi-member. I'm now a partnership with my wife. I've not made an election. So now I'm going to be a partnership. And now we have to determine, is my wife active? Am I active? Am I non-passive? Is my wife non-passive? Okay? Because then we start talking about passive activity losses. We have a lot of clients who the husband is non-passive. He spends a material amount of time, material participation in this company, more than 100 hours, and no one else spends more than him. Okay? But his wife can't also spend 100 hours, because then that means that, well, there's only one person that can do that, right?
More than 100 hours or 750 hours?
This is for entities. It's 100 hours for entities.
Okay.
The 750 is for real estate professional designation on the Schedule E when you own it in a single member LLC or you own it individually. This gets really fun. There's lots of,
Got it.
okay, so if I'm in an LLC and I own it with my husband, and my husband is a real estate professional, and he spends more than 50% of his time doing real estate, and he spends more than 100 hours on our LLC. And I'm a CPA, by the way. I'm giving you a real life scenario right now. My husband is a real estate professional, and he does have a W-2 job. And I am not materially participating. I sit in my little craftsman-style office over there, and I crunch numbers. That's what I do all day, every day, literally. So, so with that being said, when we do our tax return, I'm passive. Okay? So, and my husband is non-passive. So do I always want to be 50-50? No. Sometimes I want to be 95-5, or I want to be 99-1. I only have to have 0.1% to be a partnership. I can have 99.9 and 0.1 and still be a partnership. And then 99.9% of my loss is non-passive, which means I have no limitations, right? But I, as the passive partner at 0.1%, well, mine gets held up. Passive activity loss, I get held up for until I dispose of the partnership or until I have passive income. Okay, does that make sense?
Yes.
Okay, so now let's say that neither one of you spend 100 hours. We can't make the argument that you spend more than 50. You do own this entity together. We can't make the argument that you spend more than 50% of your time doing real estate. And we can't make the argument, whatever, right? All that. Well, it's just passive. It just ends up being passive income to you, which I'm going to go over in a little while. Could be good, could be bad. Passive is not always great. A lot of people today think, oh, I get passive, I get passive, I get passive. Well, guess what? There's extra taxes that you're going to pay if you're all passive. If you make more than $200,000, if you're single, $250,000 if you're married, filing jointly. So passive is good sometimes. Everything in taxes, by the way, is sometimes. If anybody ever tells you this is absolutely always the best way, they're lying. And I'll say that, I tell people all the time, well, generally it's this, but I don't really know because I don't know your situation, right? Like there is like an 80-20 rule, or maybe a 90-10 rule, but there's not a 100% rule. And almost, like literally, in 99% of the tax code. Okay, so if I'm an S corporation, partnership, we don't want to get in those details probably, but if I'm a partnership and I die, if you hold real estate, partnerships are usually preferred because if I die, my kids get a step up in basis. And in S corporation, it's a lot harder to get that step up in basis. You have to get evaluation, and it's a lot harder if you have real estate. So you'll see a lot of people in real estate are in partnerships. It's the most common. If you're an active operating business, S corporations are the most common. Now, one thing I'm going to hit on is investing in pass-through entities with your pass-through entity, okay? So I own a partnership with my husband, and my husband's 99% owner, and I'm a 1% owner, okay? He does more than 50% of his time in real estate, and he also, material participation, right? But then we take that and we invest in something that's completely passive. Completely passive. It's a multi-unit property, let's call it 30 units in Clemson, okay? And we own only 5%, 2%, whatever I can afford, right? 2%, 150,000, okay? Is that gonna be passive for my husband, or is it gonna be active, non-passive? We'll call it non-passive, passive.
Act.
So you're saying non-passive, you're saying passive.
Yeah.
I like
You're
it.
doing it with a second entity?
I own the entity, my husband owns the entity, and that entity owns another partnership. It's an investment.
Yeah.
It's passive.
It's one product
But when
over
I
the
get
other.
taxed on it, how do I get taxed on it?
The question I've got is, that second entity, is that the one that's doing the investing? Or is that another entity that you made to invest for you? Is the question.
So my husband is non-passive.
Right.
He is actively operating, doing real estate, and I'm passive. We invest in a passive, in that partnership, we invest in another partnership, and we own 2%. And that income or loss comes to us. Is that income or loss passive to me and my husband, or is it non-passive?
Passive. Passive.
It's non-passive to my husband.
99%.
It's non-passive to my husband.
Because of the.
It's passive to me.
Because of where the money is coming
Because of
from.
where money's coming from. So, if I own an entity and I want to get my passive activity losses, I really want my passive activity losses. I do not want them to be passive. I want them to be non-passive. Then I am going to say, husband, we are not investing in that partnership as individuals. We are investing in that partnership as our partnership. Because when that passive activity comes through, because it is passive, and you will get a K1 that says passive, the IRS tells them that CPA is required to tell the IRS this person is passive, okay? There's multiple lines on the tax return that tell the IRS that this person, this partner is passive, okay? But it comes through to an investment. In our case, it's not investment, it's an operating LLC, where my husband is 99% owner, and he is a non-passive material participating partner. So his 99% of that 2% is going to be fully deductible, the law says, okay? So this is a strategy if you want to recognize those losses. That is one way to do it, okay? But you got to know what you're doing to do it, because otherwise it can get really ugly.
Yeah.
Okay.
It's gonna get very quickly.
You like that? I love that I taught you something. Can I say that I love that? It makes me so happy, because you've been doing this a long time. Okay, so that's something that is, that's one of the tricks that we do when we have guys who have a lot of money and they are actively operating a business and then they want to recognize passive activity losses. We make sure that they invest in an entity. Most of our guys, we have the operating business as an S Corp, and they invest in a passive activity we know is going to be a loss, right? Multifamily are almost the first few years are almost all losses. So we know the first 5 years are going to be losses, and we say, hey, let's funnel it through this S Corp and let's offset that income, okay? So that's the way you can do that and it doesn't get held up. Yeah?
Is this like a step down LLC structure? Or is that what it's called, step down? Or step?
So not really, because you're investing, this idea is you're investing in a completely different entity that you have nothing to do with. The step down is typically you own.
This is
Like-
when you give me money, right?
So you're giving money directly from one LLC.
So my LLC
To another.
is going to a completely different LLC or partnership that I only own 1% or 2%.
Okay.
Like it's one of those, like, it's not a public partnership, but it's one of those things where, like, you got typically you get on the deal, you got to know people, right? Like, hey, we got this deal, it's a $10 million deal, and it's, we're looking for at least 20 investors, it's a partnership, to buy in, your minimum's 150,000, 150, you're going to own X, right? Because we got the big whale over here that's going to own 50%, and he's giving us $5 million. That's that kind of deal. Does that make sense?
Mm-hmm.
Yes. So that's what that is. So it's not step down. Step down is typically, when you talk about that strategy, that is you own and you own and you own.
Mm-hmm.
Yeah. Okay. So let's see here. Okay.
When you said partnerships is the most common because the kids step up in basis, the partnership, were you talking about you and your wife together in an LLC as a partnership?
Yep, y'all are in a partnership.
Okay.
And then you die. We don't recommend that.
Don't do it.
Try not to do that.
Zero
Okay.
stars.
Zero.
So
Just for today, try not to do
you
that.
die. You have it in the partnership agreement that your wife doesn't inherit that partnership interest, because why would you do that? Right?
She's my wife.
Who is that from?
So instead of your wife inheriting it, your kids inherit it.
Okay.
And when that happens, your CPA will do a 743B election, which basically is our 754 election, depending on, and I'm going to step up my basis. So that property gets a fair market value property at that time. They continue to do the depreciation that you and your wife had, and then they get a step up in basis, and then they start depreciating that. So they get a higher basis.
So that's a good thing.
Yes.
Yes, because it's free money.
Right? If you didn't put
It's
it-
treated as free money.
Good. Okay.
That's good.
I got you.
So if I get a
Good.
step up in basis for somebody dying, which I don't think any of us ever want our people to leave, but if they do leave, let's at least leave them something good, right? So let's get a step up in basis, and if I get a step up in basis, then, and like if I own the property myself, in my name,
Right.
and I die,
Yeah.
and I leave it to my husband, well, he gets a step up in basis 100%, like whatever my basis was, he automatically becomes the owner with a new basis, whatever the fair market value is that day. And please get appraisals. God, Lord, help. Please get appraisals. Okay?
How often?
Only when you die.
Only when you die. Okay.
Right
Yeah.
before.
I mean, you have to get appraisals other times,
I'll put
but
that in my trust.
yeah,
Thank
when you die,
Instructions.
your people need to go get appraisals on all your property.
Okay.
Like certified appraisals, because the IRS is going to want to use tax value. And almost always, not in Lexington County though, Lexington County is really good. They're ridiculous sometimes. But Newberry County, for example, I'm using Newberry County. Newberry County, the values are always lower than what the fair market value is, right? Calhoun County, holy heck. Calhoun County, like it's ridiculous.
The Wild West.
Calhoun County is the Wild West.
4 ladies living together is still considered a brothel in Calhoun County.
Yeah, so Calhoun County is another one. If you have property in Calhoun County and they use the tax value, you will absolutely pay more tax than you should when you sell that property. So get an appraisal if someone dies and you inherit. Okay, so let's see here. Now, we're going to talk about passive versus non-passive for tax purposes, qualified business income deduction versus net investment income tax. Okay, so who here believes that they want everything to be passive? Raise your hand if you want everything to be passive.
It's never 100%, you said.
It's never 100%. So I get guys that call me up and they say, Erin, we want everything to be passive. And I'm like, why? Maybe I can get that in like 2007, but why? And remember, when I'm talking about this, generally speaking, a lot of the people I work with do make more than $150,000, and quite a bit of them make more than $250,000. So I do that with that angle, okay? So if I'm sitting there and I'm talking to them, like, I want everything to be passive. I'm like, you make $700,000 a year. Why do you want everything to be passive? Because guess what? If it's passive at $250,000, every dollar of $250,000, if you're married filing jointly, you pay an extra 3.8% tax on it. Thank you, net investment income tax, the Affordable Care Act, also known as Obamacare. Okay, so that came into being in 2008 or 9. So that's why I said let's go back to 2007 for that, right? The other thing is, in 2017, a law was passed called the 2017 Tax Cuts and Jobs Act. Anybody ever heard of that? You have? Wow, I'm impressed. Okay, so that was passed by the Trump administration, and that brought into being on January 1st of 2018 the Qualified Business Income Deduction. Every small business owner in America should be praising the good Lord for that deduction, okay? I don't care what your politics are. If you're a small business owner, that is good for you, okay? So if I'm passive, not always, but if I'm passive, not always, but if I'm passive, then typically qualified business income deduction does not apply, and the net investment income tax does. The qualified business income deduction says of my net income, I don't pay 20% at the federal level. So if I have a $100,000 profit in my business, I don't pay taxes on $20,000. That's a nice gift, yeah? So if I make $400,000 and I'm non-passive, qualified business income deduction says I don't pay tax on $80,000. Do you want to do the math for me?
No.
Okay, I'll help you. We're going to do this.
No.
All right, let's say I make $1 million in my business. That means I don't pay tax on $200,000. At that point, that law just saved me $74,000.
Wow.
Okay? And I'm not paying the 3.8% on it because I'm non-passive. Okay? So this whole mantra, which I have seen many times, I've gotten so many clips, TikTok, YouTube, Instagram. I don't have social media, so when I say this, I have to watch the clip and hit the whatever, I'm not going to log in thing. I cannot tell you how many clips I've gotten from clients who say, I want to make everything passive because this guy here on the YouTube says I should. Okay? So when my clients call me and say they want to do everything the guy on YouTube says, I'm like, that was a great idea in 2007. He's 16 years late to the party. Okay? Okay? So let's just think about that, all right? So if I have a choice today under the current tax law, which sunsets in 2025, so 23, 24, 25, if I have a choice today, do I want to be passive? Do I want to be non-passive? If I'm making money, do I want to be passive or non-passive? Non-passive. It's a numbers game. It's a no-brainer, right?
Right.
I'm all about numbers. And really, I said this earlier to someone. I said, numbers don't lie and feelings don't matter, okay? Feelings don't matter when you talk about taxes because guess what? The IRS doesn't care how you feel. South Carolina Department of Revenue doesn't care how you feel.
Don't care.
They say, hey, you know what? Thanks for playing. We don't like the rules you applied, so we're going to change it. And you can appeal and you can take it to tax court, but with real estate, the IRS wins a lot because people think they can do a lot of stuff. And real estate, by the way, Congress, the real estate lobby is amazing. The real estate lobby is amazing. There's so many things the real estate lobby has done, which is so good for the real estate investor, right? So they have this law right now that it was passed in 2016, if I'm gonna do repairs, like I'm gonna paint my building, I'm gonna paint the inside of my rental property. I'm gonna do commercial because it's easier, the numbers will make more sense. So I'm gonna paint my outside of my building, and I've decided if you paint, by the way, and it's not repairs and maintenance, how long do you have to depreciate it? 39 years, okay? So I'm gonna paint it, but now I'm going to state in a document that goes in my office, it says, we will paint this building again in less than 10 years. Well, in 2016, if I made that statement, now I can deduct that painting. I do not have to depreciate that over 39 years, okay? So the real estate lobby is active, and they're good, and they do a lot of good things.
You have to depreciate it over 10 years?
No, I get to take the expense in the year I do it. Okay. Now, there is also a caveat, my repairs cannot be more than 2% of the basis, the unadjusted basis of my property. And so you gotta kind of watch that, but for the most part, if you're doing it, you're gonna be below the 2%.
The painting rule, you said commercial, but does it also work if you have houses or?
Yeah, it does.
Condos?
Yeah, I was using that as an example because a commercial usually paints
Every 10 years.
more often.
Well,
They really
houses
do
do
typically.
too, I think.
Yeah. Houses, I mean, I'll say this not to be mean to anybody who owns rental properties, but I can tell you driving around that a lot of the rental properties that I see do not get painted every 10 years.
On the outside.
What about the inside?
The
Inside counts. They got the same rule.
Oh, yeah, I'm
Yeah,
saying,
painting.
depends on the tenant.
It's any kind of repairs. And now, okay, also passed in 2016, if I have a hole in my roof, take a picture, please. If I have a hole in my roof, I can expense the replacement of my roof. If I don't have a hole in my roof and I replace my roof, I'm going to depreciate that roof for 27.5 years. If it's a residential rental.
Okay,
Okay.
I got you.
So I want
Right.
the tree. If it's about time for me to replace my roof, I am not calling the tree man. I want that tree to fall on my roof. Huh?
On the hunter.
Yeah, call the hunter. Hey, come shoot my limb out. Put a hole. I just need a hole in the roof right here so I can take a picture.
I guess it's going to be like, yeah, there's no pine trees around here.
Call a roofer.
Take it out, punch a hole in it.
Okay, so net investment income tax is 3.8%. So that's anything, if you make more than $250,000 a year, that's anything that's passive. Rental real estate is one of those things. Again, we talked about that earlier. Dividend income, capital gain income, all that stuff falls under that net investment income tax. It's a punitive tax, but it is what it is. So, okay, let's see here. Okay, those are all the things I had listed. Yes?
Well, I was gonna say, if you're getting ready to open it up, I got a question.
Yeah, I'm going to say, those are all the things I listed that I thought were like kind of fun and interesting and helpful. If there's some other topic you want to talk about, these are the things that, and Shaylin, did I say anything on the phone that I didn't cover?
No, that was everything.
Okay, that's what I thought. I had written it down, then I couldn't find my notes, and I was like, dang it, where are my notes? So I rewrote it right before I came, so yeah.
All right, so one of my goals is to acquire more properties with owner finance.
Uh-huh.
So, if, say this gentleman and his wife want to go to Aruba and they have like 30, 40 properties, and they don't want to deal with tenants anymore, and maybe say, or say all their properties are paid for in cash.
Mm-hmm.
And so if they decide to sell them, they're going to take a big capital gains hit.
Mm-hmm.
What would be their tax advantage to owner finance to me instead of selling it on the open market?
Installment sale. Yeah, installment sale.
Right.
So an installment sale, there's, okay, talk about depreciation
Like, how do I
recapture.
explain it? I want to sell it to them.
Right,
I say,
like,
this
Okay,
is
so
why you should do this.
so is this is gonna be somebody who's been depreciating their property, right?
What's that?
This will be someone you're buying from who has been depreciating their
Yes,
property.
yes,
Okay,
yes.
So depreciation recapture is a bitch. Did I say that earlier?
Right,
Okay,
yes.
I'm gonna reiterate that right
I feel like you should
now.
have that on a t-shirt. At this
Depreciation
point.
recapture is a bitch. Do you know how many clients I've gotten from people who got tax notices because they failed to recapture their depreciation? I can't tell you how many clients have walked in. My CPA, I got this notice that says I owe $25,000. And I look and I'm like, yeah, you do. And you're like, oh my gosh, right? That's a bad feeling.
Yeah.
So, but if you don't take depreciation recapture, guess what? Yeah, you got to recapture it. So, to answer your question, the benefit is going to be the installment sale. So they get a little bit of income, the capital gain income, and the interest income. Interest income, again, will be ordinary. Capital gain will be capital gain. So they'll break it out, right? Because you're going to do a note, right? And you're going to give them a great interest rate. You want to sell that.
I mean, they're going to give me a great interest rate. well, I see what you mean. No, if you're, I know-
You're gonna say, in the bank, you're only gonna get 1%, but with me, you're gonna get 7.
Right.
Right?
Never mind, I thought you meant, never mind, but yeah, go ahead.
I'm selling it for you.
Yeah.
Okay. I'm gonna give you a great interest rate. You're gonna get to recognize the income over time. It's gonna be performing. I'm gonna perform because you know it performs as your properties. Here you go. You're gonna have capital gains every year because your profit percentage, you only pay tax on your profit percentage on the installment sale. And but the one that you're gonna, their CPA is gonna, the hurdle that you're gonna hit is that in year 1 when they sell, they have to pay recapture tax the year of the sale.
Oh,
So that recapture can be really ugly.
that
So your
doesn't
down
get spread
payment?
out? That doesn't get spread out, you're saying?
No, it does not. The depreciation recapture gets recaptured in year 1 of the installment sale. So if you are going to do that, then you need to really make sure that your down payment is enough to cover the taxes on that.
So say, let's just make an example, let's say it's worth $2 million, all the properties combined, and
Okay.
they're all fully depreciated. Let's just say, or maybe say they're halfway, I don't know. but yeah.
Okay, so let's say they bought them for $1 million, they're going to sell them for $2 million, and they're fully depreciated.
Okay.
Okay, so that $1 million, they're going to pay about an average of 23% on that $1 million. So $230,000 is their tax in year 1.
Wow.
Now everything beyond that, right? Everything after that, that other $1 million every year is going to be taxed at, depending on their income, 15 to 20% at the federal level.
So that's not easy, that's not gonna be an easy sell for me, though.
Well, it depends. It depends. Remember earlier I said there's no 100%? Depends. If they have a bunch of properties they bought in the last 3 years,
Yeah.
right? But if they have a bunch of properties they've been holding for a long time, that installment sale will be an ugly experience for
I
them.
always thought, I would always heard, this is like going back to that
It's been
TikTok sort of
YouTube,
thing.
yeah.
Yeah.
I always heard that they could spread out their capital gains over the sale.
Absolutely, they can.
They can. Capital
Absolutely.
gains.
The capital gains part, they can.
But not at the.
Okay, so remember, I have a cost basis of 300,000. I have a cost basis of 300,000. I've depreciated down to 200,000.
Yeah.
My depreciation recapture is 100,000. So I'm selling this property to you for 400,000. I have 100,000 of depreciation recapture and 100,000 of capital gain. That capital gain, I can spread it out as long as you want to.
Okay.
If you want to spread it over 30 years and I say yes to you, we can do that.
Okay.
But that 100,000 of recapture,
Okay.
that's happening in year 1.
Okay.
YouTube's great. They give a lot of great ideas, but in practice, they don't always feel good.
What happens if, say, the couple's older,
Okay.
they do have 30 properties,
Okay?
I get them to sell me their portfolio, but I only make interest-only payments to them,
Uh-huh.
and then this goes on for 30 years, they only live for 20, and then their kids inherit the property. They inherit
No.
The note.
the note.
Yeah. I mean,
That covers the couple that wants to retire for the rest of their life, because they're not paying capital gains on it, correct?
yeah, they would not pay capital
It's
gains on it.
interest-only payments.
Yeah, but
The kids would, I guess, get screwed, right?
but I mean, yeah, the note, the installment sale,
Right.
then becomes the owner, the estate owns the installment sale.
Right.
Yeah.
So then when that happens, those capital gains will be paid by the kids.
Okay.
So when you're trying to determine what that down payment needs to be for the depreciation recapture tax,
Yep.
is it, okay, I can find out what the guy paid for the property 10 years ago or whenever he first bought it, find out what he paid for it. If it was $100,000, is it
Yep.
23% of that? Is it like a good rule
So
of thumb?
I was doing like, we have a graduated income tax, so that's why I was getting I was kind of guesstimating the 23% because a portion of that's going to be at a higher rate. So like if their income,
Roughly,
so
yeah.
let's say that you're buying a house for $200,000 and you want to do underfinancing. $2 million is going to be a lot more punitive, especially if $1 million of it's fully depreciated.
Well, I've got one right now that's about 200,000.
Okay,
That-
200,000. That's a
good-
great example. Okay, so if I got 200,000, let's say he bought it for 155 years ago. Is that fair? Is that a good estimate?
Sure.
Okay, so he's depreciated it for 5 years, and if it's a residential renter, it's 27.5 years. So at 150, 27.5 years, it's a few $1,000s per year. Okay. So if I want to figure it out, then I know my down payment needs to be, and I'm just going to use the highest tax rate, which is 37%. Okay? So I'm going to say, which by the way is 25%, just so you know. The recapture is technically 25%, like by statute. So when I was saying 23%, I'm talking about their whole income they were going to pay tax on that. So 25% is the recapture statute. So if I'm going to pay it, I'm going to pay 25%. So I'm gonna go in and I'm gonna say, plus state, by the way, that's only federal. Federal's 25. State's gonna be 6.5. So I'm gonna have to pay 31.5. So if it's in South Carolina. So I'm gonna go in and I'm gonna say, okay, he depreciated, it's been $3,000 a year, it's been 5 years, that's $15,000. He's gonna have to pay that when I sell, so I need to pay him at least 31.5% of $15,000 minimum on my down payment.
31.5% of $150,000.
15,000.
Where'd you get the 15?
Okay, I did 150 divided by 27.5, and I did it in my head, I don't know.
Oh, I see.
Okay, and I'm saying it's $3,000 a year. I mean, it's not exactly, but $3,000 a year. $3,000 a year for 5 years is $15,000, and that's the recapture. So my recapture is gonna be 25% federal, just 31.5%, so I'm gonna pay a third, so I'm gonna pay $5,000 down payment minimum.
I see what you're doing. I just need to call you.
Yeah,
Like,
I have a spreadsheet for that.
cool.
I have a question.
I have a spreadsheet for a lot of things, and I have a thing on my desk that says I have a spreadsheet for that, and I really do have a spreadsheet for that. Yes.
Can you explain how you extend this capital gain after a sale?
Yes. So it's an installment sale. So what happens is I go in and I say, I'm gonna use his example. I'm gonna buy your house from you for $200,000. I'm gonna give you $15,000 down because I'm, wanting to be. I mean, they're gonna only finance about 93.5% at that point, right? So that's not bad. It's better than the bank. And they're gonna say, okay. And so then they're giving you a note for $185,000. You agree with that?
Yep.
Okay. So now that note I'm going to pay interest on. And I'm going to amortize that over whatever period they'll let me. Most of these loans, by the way, owner financing, in our office, we don't have any that are more than 5 years. So when you're talking about owner financing, the majority of them are 5 years with a balloon. Okay? The majority.
5-year amortization? Or
20-year amortization or a 25-year amortization with a 5-year balloon.
Just like the bank. Yeah.
Just like a bank.
Yeah.
Because a lot of the owner financing people are fine with it, but they don't really want to be a financier or a lender for the rest of their life, right? So they're going to say, okay, we'll do that, $185,000, 7% for 20-year AM, or 20-year AM is the most common, but 20 or 25-year AM, 5-year balloon. So you're going to make that payment. When you make that payment's broken down between a interest and a principal. Agree?
Yep.
So my principal portion is going to be the capital gain calculation. So in year 1, my capital gain is going to be kind of small, but my interest is going to be high, right? But my capital gain is going to be based on, and I'm going to use his example, 150, I depreciated 15, so my basis is now 135. My gain is 200 minus 135, right? So I have a $65,000 gain. Well, that $65,000 is going to be spread over the 5 years, and the first year I'm going to pay a very small portion on that $65,000.
Okay.
Does that make sense?
Yep.
Okay.
But the seller has to worry about all their own taxes.
Yeah.
Buyer, me, doesn't have to worry about the seller's taxes.
Only if it becomes a problem for you.
Only if you need help to know it so that
Yeah,
you can sell it to the
if
guy.
you want to do owner financing, it could matter. I mean, if you're the buyer, the reason it matters is because, like, we had a guy who sold a property in New York State in 2021. He had owned the business since 2005. It had real estate and property. Personal property. When he sold the business on an installment sale, he owed more taxes on the recapture than he got as a down payment. So he was pissed, right? That's when it matters.
What did he do?
Well, whenever the CPA told him what was going to happen, they had not closed yet.
Oh, he pulled out. Okay, got it.
No, he didn't pull out. He went back and he said, I have taken this deal to my CPA, and
Yeah.
we said to him,
Renegotiated, right?
you are not going to be able to pay your taxes with your down payment. And he was like, what? Like, I can't do that. So he went back and renegotiated, and they said, well, how much is your tax, and whatever. And then it became a problem for the buyer because the buyer had to come up with more cash. So that's when it matters.
I always just tell people, talk to your CPA. I'm just the guy buying the 5,000.
Yeah.
I bought a bunch of them this way, and
Yeah.
I learned this trick from a buyer.
Right.
They were selling their whole portfolio.
Yep.
And they had sold some for cash. They had 1031 some.
Yep.
And then they took my seller finance offer, which was.
So the 1031s on the recapture on the 1031s is going to be brutal, especially if you've 1031 a few times.
They basically are moving to the beach. Again, what did they do with their life? Is that-
No, it's totally up to them. The only time it matters to the buyer is whenever the buyer, whenever the seller says, I can't pay my taxes. Like, I'm cool doing this for you, but I can't pay my taxes. And then it becomes a thing. That's the only time.
I don't know, I got a house that's appreciated like crazy since then, so I'm totally stoked about that one.
Okay,
Do you
yes.
ever recommend, so since you're talking a lot about depreciation,
Yeah.
do you ever recommend not depreciating your house? Not
Ooh, I
taking-
am so glad you asked that question. I love that question. That's an excellent one. We have some CPAs who have deployed that strategy, and you know what? It really sucks. Really, really bad.
So it's a bitch either way.
I would say not appreciating is a bigger bitch. You know what the IRS says?
Okay.
The IRS statute says allowed or allowable. If you didn't take it, too bad for you.
Ah.
When you calculate the sale of that house, we treat it as if you did depreciate it. If you didn't take it in the year that you were allowed to depreciate it, it's allowed or allowable. And the IRS says, if you didn't take it and you were allowed to, too bad. You have to calculate it as if you did. So we had a guy who had a house for 8 years. He rented it for 8 years. He called me up. He'd done his own taxes for 8 years. He said, will you help me do this? And I said, sure. So we did it. And I called him up and I said, did you depreciate this house? Because on your schedule, I don't see where you depreciated it. No, I didn't want you to depreciate it. I heard how bad depreciation is and how it hurts when you sell. So yeah, it's going to hurt real bad, honey. You're going to owe a lot.
I'm so
So
sorry.
they more or less just take that basis and drop it down regardless if you take it or not.
They treat it as if you depreciated it, even if it's called allowed or allowable.
Oh, that's crazy. Wow.
So if you don't depreciate, it doesn't matter.
You're gonna get it
You just lose it. So take it.
To take it, yeah.
Take it. Allowed or allowable is a doctrine that is extremely painful. Very painful. And this gentleman decided to amend his tax return for 3 years. All that was open, we amended.
Oh, so got some of
I'm
that.
gonna try to use
But for the 5 years, he just lost it.
It was allowed. He was chosen.
So it's very painful. Do not do that. Take your depreciation. Yes.
What if you sell a business that owns an entity, or owns property? I think you mentioned that a minute ago.
If I sell a business I did, but my guy in New York State did that. No, he lives in South Carolina now. I try not to do New York State tax returns. California, Oregon. Whew, Oregon. I hate Oregon. Can I tell you that?
Yes.
Don't be offended, please. You're here, so
Here it's
I presume you're not going to be offended. Oregon taxes are the most onerous. I don't know if Massachusetts is worse or Oregon, but Oregon is horrible, and every year they become worse. I really think Oregon's the worst state in the union right now with taxes. Do not live in Oregon. Do not invest in Oregon. Do not do anything in Oregon. Stay as far away from Oregon as you can stay. California is no good either. Stay away from California, and don't go to New York either, because New York. But Oregon's the worst. So there you go. We file tax returns in like 30-something states. You what now?
So
How do you feel about Oregon? I'm confused.
I know. I oftentimes leave people confused.
Is that an absolute, like?
It's an absolute. Yeah, I have like 30 clients in Oregon. I deal with Oregon almost every day. I'm growing to despise it. Okay, so when I sell a business that owns property, what happens is, which I don't recommend, by the way. I don't recommend that you have your real estate inside the operating. So if I have an S corporation, I don't want my real estate inside that S corporation, right? Like, we had a client who just sold, and unfortunately, before they came to me, their CPA had put their real estate inside the S corporation. So when they sold, they
That's corp or the house?
no, theirs is a business. Like, the businesses that I typically work with own commercial real estate in one way, shape, or form. And in this particular case, they closed the day before Thanksgiving, and Tuesday before Thanksgiving, actually. And when they sold, most people they don't want to buy the real estate and the business. They want to buy the real estate and the business. Does that make sense? They don't want to buy it as one.
Or one or the other.
Yeah, or they want to buy one or the other. So in this particular case, what happens is that you do have to allocate, by statute, you have to allocate between the personal property that you're purchasing and the real estate that you're purchasing. So if you have it all together, they have to, like, most buyers are going to come in, they're going to say, we're buying your real estate for $2 million. We're buying your business for $3 million, right? They're not going to buy it all as one, because then it can get really, really hairy, really fast. Because when you buy a business, you're going to buy goodwill almost guaranteed, especially a small business, because their basis and their assets is going to be very low. So, like, if I sell a business, I own a business, and I'm going to use an example of an HVAC company. So I'm an HVAC company. I own a bunch of trucks, which pretty much all own, right? HVAC companies don't own anything but trucks. Or I'm a dumpster company, I own trucks and dumpsters, either one. But I've depreciated them, right? I'm depreciating my dumpsters, right? And I'm depreciating them as quickly as I can. Because why do I want to pay tax when I don't have to, right? So then somebody comes along and they say, I want to buy your business, and I want to buy your commercial real estate, because I want to buy it all. But I'm going to buy it in two separate transactions. I'm going to buy your business and I'm going to buy your real estate. The real estate is going to be a fair market, typically is a fair market value transaction. They kind of get appraisals, they go around, whatever. And then they go to the business and they buy the business for whatever they decided their total purchase price was going to be, typically depending on cash flows of the business, right? So if I am the buyer and I'm buying a business that has real estate and an operating business, I'm definitely buying my real estate separate. And if I really was smart, I would probably buy my real estate below fair market value. Okay?
Yep.
Because I don't want that depreciation over 39 years.
Talking about appraisals, I'm like, can we just do like $1 for the?
No. That's only when you die, because you want to step up in basis. We want appraisals when you go up.
Yeah.
We don't want appraisals when you go down. Okay, so I'm going to go to him and I'm going to say, okay, I see your business, your total cash flows, whatever. I think I can buy your business for $3 million. Okay? $3 million, I'm going to say, oh, your real estate, well, the tax value is $600,000. Fair market value might be $1 million. But that tax value looks really good. I'm going to buy your business, I'm going to buy your property for $600,000, but I'm going to buy your business for $2.4 million. Okay? Do you like that as a seller, or do you like that as a buyer? Who likes it more? The buyer does. Because when I buy the business for $2.4 million, almost guaranteed his assets are fully depreciated, which he doesn't love because he has to recapture all that ordinary income, not fun, right? But the capital gain part, goodwill I'm buying, is depreciated or amortized over 15 years versus 39 years. So as the buyer, I like it. As a seller, except for my ordinary income recapture, I like it, right? And I really don't care, to be honest with you, because at the end of the day, it's all capital gain. Like beyond my recapture, it's all capital gain, so it doesn't matter. But the buyer, it matters. So that's what I would do if I were the buyer. I'd allocate it out and do as low as I could on the real estate side. And by the way, that also determines your your real estate property tax. So let's keep it as low as we can, right?
Right.
That's what I was saying, is I would just.
Real estate property taxes.
Responsible for real estate taxes.
Real estate property taxes in South Carolina are lower than the national average. However, for businesses, they are not really. They don't feel that way anyway.
Yeah, rental properties.
Yeah, 6%. And your business personal property, dumpsters, and that kind of thing are 10.5%.
Yeah, they suck. I'm trying to figure out how the hell my truck that I bought brand new last year only went down $17.25 this year.
You don't want to know how? Is it Lexington County or is it Richland County?
It's Richland County.
I don't know Richland County. Richland County probably raised taxes, but Lexington County raised taxes. Lexington County raised taxes substantially.
Well, 55% goes to school. I ain't got a kid in school.
Yeah. Welcome to South Carolina law. That's called Act 388. If you can get all of you people who own real estate who is not your principal residence, you'll love this comment or this little tidbit. You might love it, you might hate it. I don't know. So Act 388 was passed, 2008, I think. Basically, Act 388 says that all non-residential rental, non-residential, like not my principal residence, and all commercial property is going to be treated at 6%, which means they pay the lion's share of the taxes in the state of South Carolina, which goes to the schools. And all the residentials pay 4%, and if you're over 65 and it's your principal residence, then you get the homestead exemption. Okay? So if y'all have noticed, South Carolina has become a little bit of a retirement state. I don't know if y'all noticed this or not, but it's happening. It's true. That's really, really bad if you want to get down to the nuts and bolts of it. Because a kid in Lexington District 5 costs $13,000 a year to educate. How much does that house pay that they're staying in? I got an example for you, actually. Okay? I have a friend. They moved here from Idaho. They live on the lake. They bought their house for $600,000. They pay about $4,000 a year in taxes. They have 5 kids in the school district. 5 times 13 is what? $65,000 a year that we as taxpayers are paying to educate their kids, because that's what it costs in District 5. That's District 5's published numbers, $13,000, and they're paying $4,000. They do not own a business. They do not own a property. They pay $4,000 a year to educate their kids. So who's paying for that?
Business
Every single person that owns a rental property and every single person that owns a business.
But not your own house, right?
Not your own house. Your own house is 4%. Yeah. So if you want to change the landscape, you got to talk to your state representatives, which good luck. But